Good to have you with us this morning. Let's kick things off this hour with another look at the U.S. futures. We are seeing a bit of a cool down after the steady climb that played out in the past month. Both the TSX and S&P 500 rallied again on Friday. Investors have decided that the path ahead for interest rates is likely lower, almost regardless of what central bankers or the economic data tells us right now. Not to suggest that there aren't some good signs on that front, but remember, in Canada, we had jobs growth on Friday. Investors, though, instead focused on the fact that the unemployment rate is rising. Stateside, just the idea of U.S. Fed Chair Jay Powell vowing to move more carefully on rates inspired investors. But again, he's still keeping some of those caveats for higher rates in his messaging. At the end of the day, this is setting up an interesting bull-bear conversation heading into the end of the year. Some of the bears barking back already this morning. Morgan Stanley strategist Michael Wilson predicting a rocky end to the year for stocks. But will investors, including those who perhaps felt burned by bearish views this year, ignore such warnings? Let's talk more about the outlook now. Phillip Peterson joining us, Chief Investment Strategist at IG Wealth Management. Nice to see you.
Good to be here.
Okay, well, where do you weigh in on all this right now?
Well, I think the phrase everything in moderation comes well into play here, which is the Fed going to cut interest rates? Yes, but in moderation. Is the economy slowing down? Yes, but in moderation, right? We shouldn't look at the extremes on any side. And I think that's what perhaps the market is suggesting, is that, you know what, we're not headed towards a deep recession, and the economy, while slowing down, isn't heading into a crevice. And so things, as they're moderating, that's good. And in particular, if you look at where the growth in the market has been coming from, it hasn't been the Magnificent Seven, it's been the forgotten 493. If we put it that way, and there we're seeing a bit of a rally.
Is that your bumper sticker? I mean, we should.
I think I'm going to trademark that.
Okay, good. Yeah, that's good. Right. Banks, I think. Financials are an example of a group that have been rallying recently.
Exactly. Yeah. And it's something that we paid attention to last week when you start to look at the market being ahead, and then you say, okay, well, where are the internals coming from? And you see, well, look, the majority of the stocks were up about 400 and change each of the last couple of days, but which ones weren't? And it was the Magnificent Seven.
Now, figuring out the path forward, I think it is fair to say, has been a top consideration for investors, because getting it right in the short term is always hard. But even if I look at the charts for the Canadian and U.S. markets going back to, call it, the summer, because remember, before the November rally, we had weakness in August and September and October. We're basically back to where we were, give or take. Mm-hmm. And I guess that idea of what you talked about, if the economy is cooling down, but not to disastrous levels, and there's enough out there on the inflation fight that would justify less of a need to raise interest rates going forward. These are the and assuming another assumption, corporate profits hold up. These are all the kinds of things that would keep people in the game.
Yeah, exactly, and that's what we're seeing. In truth, there is no reason for the Federal Reserve or the Bank of Canada to raise rates further than where we are today. Inflation has moderated to a very comfortable level. Unemployment is nudging up a little bit, and we expect it to go up a little bit. But again, if you think about a recessionary environment, what does unemployment look like? Well, 8 to 12%. Are we headed there? No. The labor market is too tight, in our view, for that. So if the consumer has a job, they're going to continue to spend. And if they continue to spend, then we can see a rebound in corporate profitability in 2024.
Okay, so let's just take the last month. Let's see this through the lens of the TSX, where pretty much all sectors have seen positive performance over that stretch. Not all sectors equal. And you mentioned how financials had joined groups like technology in the recent rally. Are there sectors that you're leaning into right now that you think would be better bets for investors, given this sort of moderation, if you will, just in terms of expectations and performance, all that kind of stuff?
In Canada, yeah. I think if you look at the banks, what has been coming out of the banks? Well, loan loss provisions have been picking up, and that's to be expected, right? And the banks typically over-provision, right? They're more conservative going into an environment like we are, because the market is accepting of that. And so when I look at the financials, I do see attractive valuations, attractive dividends, and well-run businesses that give yourself a little bit of time, but I think there is some attractive upside from here.
Do you think there was a conversation on the street earlier today, even about the telecom sector, about the fact that if we are now at a point where we can have more confidence that rates have peaked, that companies that have reasonable dividends might be more in favor with investors?
They could. It depends if that company is more utility-like and that dividend is high and unlikely to grow at an above-average pace, and therefore these companies are like bonds. Sorry, no, the other way around. Yes, I would say yes. And thinking about that, so if you have an attractive dividend and interest rates start to come down, those dividends become more attractive as we go forward.
And then what about the oil sector, which is, I mean, it's been so volatile over the last few months. Everybody knows that. But you have this chorus of guests who come on. They make very compelling cases for the valuations for energy-related stocks, the long-term story of crude. We've talked with you many times before about it. I mean, I imagine you're still bullish over the longer term on this group?
Longer term, yes. You know, what I think has been challenging for the sector right now is that supply has come up. Yes, we have OPEC committing to further cuts, but the U.S. is increasing production. We've seen the U.S. production go up by 1 million barrels a day since July, and that's offsetting the cuts by OPEC. And so, you know, we don't quite have that deficit in oil that would push that price higher, and demand in a softening global economy is easing.
Yeah, because it was interesting last week, and we can show people the oil chart again, but you saw OPEC Plus failing to initially reach consensus, so they had to push out their conversation. So you saw weakness on that. And then when we actually got them reaching consensus, people kind of had a meh reaction. I think oil was down between 4 and 5%. And some analysts have said, well, now in many ways they're out of bullets, you know, whether that's true or not. But I think that sort of speaks to what you're talking about.
Yeah, and the bigger question is how many of OPEC's members will actually adhere to the cuts. There was a lot of resistance against that just because of government budgets and what governments need to meet in terms of revenue targets, and whether they can actually fulfill these cuts without doing significant economic harm to their own countries.
Let's, before we wrap things up, talk a little bit about gold, which we saw hit a new all-time high, I believe, today. The idea of lower interest rates is getting a lot of attention. I guess you've still got geopolitical uncertainty right now. But we've seen this big run-up. So how do you feel about investing in gold or gold-related names or the materials sector, that kind of stuff?
Yeah, I like gold. I've liked gold for a while. We have a couple of different valuation metrics on gold that suggest that it could be worth $2,400, $2,500 an ounce. So, gold has been one of the undervalued asset classes out there, and I do think it can run further from here. The tricky thing about gold is it can disappoint for a while before it catches up. I think we are in that catch-up phase right now, though.
Yes, there is that long-term. We've got definitely the long-term gold bugs who have been coming on BNN Bloomberg for more than 2 decades. The U.S. dollar is part of that story. Is that something you have to watch as well?
Absolutely. As we see the U.S. dollar weaken against the basket of global currencies, it tends to be inversely related to gold. As the U.S. dollar weakens, gold should do stronger. Gold is cheaper relative to the S&P 500. Gold is cheaper relative to the money supply. So there's a number of factors that can push gold higher from here.
Okay.